Are you worried a market crash could just wipe out your retirement savings? It's a fear that keeps a lot of us up at night. Well, today, we're going to look at a strategy that's designed to help you sleep a little better, a way to protect your nest egg from a major downturn. All right, let's get into it. For years, the number one rule in investing has always been buy and hold, right? But what happens if the market doesn't just take a little dip? What if it goes into a full-blown coma for years, or even decades? If that happens, is just holding on the smartest move? Or is it maybe a recipe for disaster? And look, this isn't just some theoretical what if. Let's make it real. Picture this. You invested in the Japanese stock market right at its peak in 1989. For the next 30 years, you would have had to watch your investment just languish. On average, it would have been worth less than half of what you put in. That's not a scary story. It's a cold, hard fact. And that brings us to the ultimate nightmare scenario for any investor, but especially for folks who are getting close to retirement: a decades-long market winter. What does that kind of deep freeze actually mean for your future, for your retirement plans, for your peace of mind? Now, sure, if you're in your 20s or 30s, you've got time on your side. You can afford to wait out a downturn. But if you're near retirement, or maybe you're already there, and that portfolio is what you're living on, well, a few years of zero or negative returns isn't just some bump in the road. It's a catastrophe. It's the kind of thing that can force you to completely change your lifestyle and just drain your savings way faster than you ever planned. So, if that old buy and hold mantra has this pretty big, potentially fatal flaw, what's the alternative? Is there some way to build a safety net right into your investment strategy? Well, that's exactly where a rules-based approach called trend following comes into the picture. Okay, this next point is absolutely crucial, so let's be super clear. Trend following is not the same thing as market timing. We are not trying to predict the future with a crystal ball here. Think of it like this. A market timer tries to predict when it's going to rain. A trend follower looks out the window, sees it's already raining, and then goes and grabs an umbrella. See the difference? It's all about reacting to what's happening right now based on a strict set of rules, and that's what helps take all that emotion and guesswork out of your decisions. And hey, don't just take my word for it. There's a solid academic consensus that trend following is a legitimate, well-documented strategy. It can be a really valuable way to diversify, and get this, it can even perform well during major market crises. Experts call that crisis alpha. So, how does this actually work? What's going on behind the scenes? Let's pop the hood and take a quick look at the mechanics of two of the most common trend following methods out there. Okay, first up is the excess return method. It's actually pretty simple. It just asks a basic question. Over the last year, is this stock doing better than something super safe, like a US Treasury bond? If the answer is yes, you stay in. If the answer is no, you get out and move your money to that safer asset. Easy enough, right? The second method, the moving average method, is a little more technical. You've probably heard of this. It looks for signals like the famous golden cross. That's when a short-term average, like the 50-day, crosses above a long-term one, like the 200-day. That's your green light, your buy signal. The opposite is a death cross, when the short-term dips below the long-term, and that's your signal to sell. Now, theory is one thing, but the proof, as they say, is in the pudding. So how did these strategies actually do when they were put to the test? Well, researchers back-tested them against 50 of the biggest stock ETFs to see how they stacked up against just a simple buy and hold strategy. And, well, the results might just surprise you. Before we jump into those results, we need to talk about a key idea called maximum drawdown. It's a really powerful concept. Basically, it measures the biggest single drop your portfolio would have taken, from its absolute highest peak down to its lowest valley. In other words, it shows you the worst case scenario. It's a number that quantifies the amount of financial pain you would have had to live through. All right, now take a look at this chart. The thing that should just jump right out at you is the huge difference between those blue boxes. On the far right, you've got this massive range of potential losses for the buy and hold strategy. But look to the left at the two trend following methods. The boxes are way smaller and they're positioned much, much higher up. That right there is a picture of just how much risk this kind of strategy can take off the table. Let's put a hard number on that because it's pretty staggering. The median maximum loss for a buy and hold investor in this study was a stomach-churning 55%. With trend following, that number was slashed to around 31%. I mean, think about that. That's the difference between losing over half your money and losing less than a third. For someone in retirement, that is a world of difference. Of course, protecting yourself from the downside is only half the story. You still want your money to grow, right?
So what about the returns? For that, we need to look at another number, the compound annual growth rate, or CAGR.
And here's where you can really see the trade-off. The excess return method, incredibly, just about matched the returns of buy and hold. That's pretty amazing. The moving average method, on the other hand, gave up about 2 percentage points a year in returns. You can almost think of that as the insurance premium you're paying for all that downside protection. So the big question is that premium worth the peace of mind it buys you?
To answer that question, we've got to look at our last and maybe our most important metric, the Sharpe ratio. Now, this is the real game changer. It doesn't just look at returns. It looks at the return you get for every single unit of risk you take on. And with the Sharpe ratio, a higher number is always better. It means your portfolio is working smarter, not just harder.
And this is where it all clicks into place. Just look at the median lines inside those blue boxes. Both of the trend-following strategies delivered a significantly higher Sharpe ratio than buy and hold did. And that's the key. That's the big aha moment. Even if the total returns were sometimes a little lower, the quality of those returns, that risk-adjusted performance, was way, way better.
This simple chart just makes that point crystal clear. Buy and hold, a Sharpe ratio of 0.56. The trend-following methods, they came in at 0.65 and 0.67. What that means in plain English is you're just getting a more efficient return for your money. You're getting a much smoother ride. So what this all boils down to really is a classic risk-reward trade-off. A trend-following strategy is essentially willing to give up a little bit of that sky-high potential in the best of times in order to avoid those catastrophic losses in the worst of times.
And you can see that trade-off happening right here in this chart of the QQQ NASDAQ ETF. That top line is the price of the ETF. The dotted lines, those are the trading signals from the trend-following strategy. Look closely. Notice how the strategy got out of the market. It sold the ETF right as the dot-com bubble was bursting back in 2000. And then it did it again right before the worst of the 2008 financial crisis. It basically sidestepped two of the biggest market meltdowns of the last quarter century.
So let's wrap this up. What are the big takeaways here? First, trend following can be a really powerful tool for cutting down your risk of those huge portfolio-crushing losses. Second, that protection isn't free. It might cost you a tiny bit of the upside in a crazy bull market. But third, and this is the most important part, the data really suggests it gives you a much better risk-adjusted return over the long haul. And for a lot of us, that's the smarter, more sustainable way to build and, just as importantly, preserve our wealth.
And that really brings us to the final question, and it's one you should ask about your own portfolio. When the next big downturn inevitably comes around, is your portfolio built with a plan to react based on disciplined rules, or is your only plan to just close your eyes, grit your teeth, and hope for the best? It's something to think about. Thanks for tuning in.